There are some things I'll take a chance on, but life is already enough of a gamble for me to put my whole nest egg in the share market. So I take a calmer path. By investing in private credit, I know my money could be growing, not yo-yoing.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. Great to have you with us here at AusBiz as we round out the day and the week. Let's take a look at where we have landed at the end of the week. Bit of a day, it has to be said. Today, marginally lower on the COB 200, whereas the ASX 200 just in negative territory. It's just been bumping along and pretty flat essentially in the afternoon session. So that actually takes us to a high point in the week, but only just. Let's get to the themes of the day. We've got a weekly win. Yeah, well, maybe that's overstating it. We're up about 1/3% over the course of the week. Crude conflict. Well, of course, that is off the back of that Trump administration decision to impose sanctions on Russia's two biggest oil exporters, putting pressure on their biggest customers in terms of India and China to stop buying that oil. This, of course, all to do with the conflict in Ukraine. And inflation watch. Well, we're getting that tonight. That is due out in the US ahead of the Fed decision next week. Also next week, we get our own read on inflation too, ahead of the following week's RBA meeting. Now, also I should point out, we've got ahead of the US-China trade talks next week when President Xi meets President Trump for the first time since President Trump landed in the office for a second time. That's in South Korea, which is hosting the APEC summit. This comes after President Xi outlined China's 5-year plan of becoming self-reliant and a tech superpower. Well, let's get to those sectors moving today. No surprise that energy was the leader there. Let's check in on those stocks. And also off the back of Woodside updating the market too. More recently, Standard's actually coming off negatively. There's still trouble at the top there just in regards to, well, I think we've had 3 failed takeover bids for Santos. Pressure on the board there. Lithium, they were among the best performers today, I guess supporting more what's going on in the critical mineral space at this point. Also, PLS out with an update. I'll get to that in just a moment. Mineral Resources, Liontown also doing very well, along with Core. And the tech space, checking in on that, just a little mixed at this point. Let's get to the top stories of the day. Newmont, the gold miner, noting that its cost savings and favourable macroeconomic conditions are being offset by higher royalties and production taxes. PLS, the lithium miner, has reaffirmed its FY26 production guidance and unit operating costs coming around 12% lower over the September quarter. Whitehaven Coal seen a 3% improvement in coal sales quarter on quarter, digging into its stocks as production came in lower. Zip has signed a deal with Stripe in the US, and the ACCC has cleared the way for Cuscal to acquire payment facilitation supply Indu. GPT, it's purchased a stake in Sydney office tower Grosvenor Place, and corporate travel management has seen a 6% increase in revenue over the first quarter of FY26, some 30% jump in underlying earnings. It remains suspended though, and EVT having held its AGM today with the group reporting a 21% increase in earnings for the first quarter of FY26. Well, let's get an assessment of what we've seen over the course of today and the week. George Maouris joining us from K2 Asset Management. George, lovely to have you in the studio. Good to see you.
Good to be here. Thank you for having me in the studio.
Let's start with, why don't we start with geopolitics, because that is ever present as far as markets are concerned. We do have the Xi-Trump meeting coming up. Trade tensions simmering, and then of course overnight we had those sanctions on Russian oil producers. How's this playing out for markets, do you think?
Yeah, very difficult. So there's headlines, and the headlines are amplified, and I always say it's theatre and noise, because markets have got to look through that headline, the geopolitical, and see what are the implications for leading indicators, and they are future earnings, future credit conditions, yield curves, etc. So you need to be pragmatic and objective and look through it, because the geopolitics and the amplified entertainment we get from the White House, there's no shortage of headlines as they're trying to negotiate what they've got to do. But understand first and foremost, what's the implication for credit conditions, economic conditions, and future earnings when you're reading these headlines, because people are very emotive about them, and there's many moving parts. Everything from the crude, penalty from obviously the Indian and Chinese economy, obviously buying the Russian crude. The Russian crude is financing a war. That's high level and oversimplification. They're attacking that. It's convenient that the US is obviously now self-sufficient in energy production. So so you can be cynical about it, but that's the reality of the whole thing. But the thing to take a step back is, what's the implication for what's going to happen to the economy and future conditions? That's what it is. Markets are pricing in future expectations. When they change quickly, that's called volatility.
Can I ask you about China? I referenced that a little earlier. It's come up with its 5-year plan. I think I was talking to you earlier. You said, well, it can come up with any plan it wants, really.
Yeah, exactly.
But interesting, the President, she was talking about the storms ahead. It was sounding fairly ominous.
Yeah, so everything Xi and Beijing do is very calculated. A 5-year plan can be a 10-year plan or a 5-minute plan. It's whatever they want it to be, whenever they want it to be. We all know that domestic demand situation in China is improving from a very low base following the largest property correction the planet's ever seen. That takes 7, 8, 9 years for the balance sheet recession to be resolved at the household level and at the local municipal level that can't sell properties to get the receipts and tax receipts to function. So they've got a major issue, what we call domestic demand. It's coming out of a low base, but then they've got the best export sector in the world. They can go anywhere in the world, most efficient export sector, and underprice everybody. And that X minus M, the exports minus import, is the largest contribution to that second largest economy of their economic growth. So I've said a lot very quickly there. So China will control the narrative, and it's a very key part of the globe, but its export sector, first and foremost, is the best, and it's the largest contribution to their economy, but domestic demand is still quite weak, nevertheless improving from a low base. So the 5-year plan, I was a bit tongue-in-cheek. It can be the 50-year plan or the 5-minute plan. It's whatever they want it to be, whenever they want it to be, as they control that narrative. But their export sector is very efficient, because it can just undercut everybody. Because remember, in other parts of the world, they don't have to make profit. And in Europe, what do? They tax profit. So it's a very good move.
You mentioned that word control with China. That's what they're all about, certainly as far as the CCP is concerned. Also, obviously, control over critical minerals,
yes,
given its dominance on 90% of the global market. Of course, we had that deal earlier in the week between Australia and the US. What did you make of what you heard from the White House?
It's just strategic alignment. So the US, Canada, Australia and the UK, regardless of what people say in the headlines, is that strategic alliance. Australia, we're really walking on eggshells, because our largest are iron ore, coke and coal, thermal coal, LNG markets are to the north of us. So Beijing's a big participant of our top exports. Even education, which is is our largest services export, is still important. So we're walking eggshells, and as long as we do it in a way that you can take a little bit of criticism from China, just take it on the chin, and then obviously work strategically with the US, Canada and the UK, as we've done in the past. That seems to make a lot of sense. A lot of work went in the background of this, and we just got to see how it plays out. But Australia seems to have a good place managing its potential conflicts of very different markets.
George, turning to equities, of course, earnings season underway in the States at the moment. We've had a couple of the mega cap tech stocks. We had Tesla and Netflix this week. What's your take out, particularly, I guess, the backdrop there of that AI trade continuing apace?
Yeah, so high level, first half of the last 2 quarterly earnings been very robust in North America, and expectations of earnings will revise higher from the momentum of the first half. We started the quarterly earnings for the September quarter effectively last week with the financials, reinforcing that steeper yield curve and volatility of trading leading to the net interest margins been maintained or expanding in some parts. That's been quite good. So the momentum of the earnings into the 4th year of double-digit EPS growth for North America is astonishing. It looks like it's tired and fatigued, but it's not. It's still there. And what's happening with Telstra and technology and the AI, they are pricing in an awful lot of good news. That is true. And that is why the multiple at 23 times versus 16.5 times for the long run average for the S&P 500 is quite expensive. So to pay $23 for $1 of earnings of something that you could have paid 16.5 over the long run, but it's justifiable in part. It's not quite a bubble, but it is exuberance to some degree, and with exuberance it can run for a couple of more years. But this is the key point. You can lose money today if you buy and want to exit 1 year forward. You're buying for a 3 to 5 year. So structurally it's still an upward projection, but the volatility is still there. That's the thing to reinforce when you're looking at equities, because of the volatility component. But the earnings are coming through. Unlike the re-rating in Europe, the earnings are really been quite negative and they're very low, but the re-rating is about the opportunity and the upside, particularly with the German economy into its third year of a recession. That's a re-rating of their equity market on the expectations that earnings grow from that contraction relative to the US, where they're expensive from earnings actually being there. So two different markets to play for different reasons, but there's upside from Europe because of the low valuation relative to the US, but you're taking the risk because the earnings haven't been there just yet.
Is there any reason why the bull market can't continue beyond the end of the year? And I'll ask you in reference to the Australian market as well.
Yeah, so Australian market, cut and paste for the US, a little bit different. We don't have the technology sort of part of the index, and energy is a large contribution, notwithstanding the frustration of what Santos is doing to itself. But outside of that, energy can have a re-rating in Australia going forward. But very quickly, it's expensive earnings in Australia, but this is another overgeneralisation, and I'm saying this twice now, that people believe that governments and people believe that central banks and regulators effectively are a put. They're there to correct the downside. In essence, they're believing. So that's why you're getting this, what people call a melt up. They're getting a frustration of it. But valuations in Australia are expensive as well, but we don't have the diversification across the sectors as we do in the North America, where if you take the technology out of North America, valuations fall away, Russell 2000 in particular, and the mid-cap sector, and there's opportunities there. But in Australia, we're becoming very expensive in the top 20 stocks, and our small caps, which have been underperforming for effectively 20 years relative to the large cap, they're very sensitive to the economic cycle. So there's opportunity there, but we do need that lower rate environment in Australia, but it won't be as low as people want. That's the thing to reinforce.
George, is that US debasement trade still there?
In part, but not everyone can have a weaker currency. This is why gold did what it did over the last year. So with Tane Takaichi in Japan, she wanted the weaker yen, which is good for Japanese profits. The US liked the weaker US dollar unofficially, and the euro rallied while it was in recession from 103 to 117. It didn't need that either. So the debasement theory is basically spilling off into other areas, and gold is one of them, silver as well. It can't continue on forever, but the thing to reinforce is government debt is increasing as a percentage of GDP, and that is creating, swap is widening, which is basically saying that no one's dealing with the debt issues. They're saying they're going to try and do it, but look what Germany and France are doing. France is going out of its way to shoot itself in the foot every possible time when it comes to issuing bonds, and hence the credit downgrade they've got there. I think they're rated the same as the Victorian state at the moment. So they'll keep doing that. The UK government, they got yields 75, 80 basis points higher in their 30-year when Theresa May did that shock budget. So they're paying much more in this current government what they're doing. And Germany is obviously well priced for it, but they're going to have to unload the biggest government stimulus the world's ever seen for 90 odd years. So the thing to reinforce here is that is creating a little bit of that debasement hedging at the margin. It's all about at the margin as opposed to en masse, because the world economy still has one currency, that is the US dollar, and the US dollar debt is still the risk-free rate, and there's so much issuance. And notwithstanding what people say, a lot of foreigners are buying US dollar bonds, and particularly at the auction.
George, always terrific to get your worldview. Thanks for joining us from K2 Asset Management.
Thanks for having me.
Well, let's now turn to our stock of the day. We had a small cap special today on the call. Our experts, Richard Hemming from Under the Radar and Luke Winchester from Area of the Capital, got across a motive.
Look, I think it's just one of those stocks that's a good core position in your portfolio if you think that they can, keep paying dividends. Like, it's pretty much a kind of a bond type returns. So I like. It's not something you would sell, but you could use the dividends, I think, to definitely bulk up your portfolio.
I just think there's better places to be. This is one where it's done okay in the past, but we flashed up that 5-year chart before. It's really gone nowhere for 5 odd years. Your dividend's sort of your only source of return. So I reckon this is one that I would actually just move on from and exit this one and find something else that maybe just has, doesn't have the same headwinds. It's hard in this game to own things that are going to sort of struggle operationally over the next year or two.
So let's sum up what we've seen today, checking in on the winners and losers in today's trade, and certainly in the lithium space. Liontown, PLS, IGO also significantly higher there. Temple & Webster doing well, along with Alcoa, which has benefited clearly also from that critical minerals deal out of the US. On the negative side, Newmont updating the market with its quarterly today, which was not well received. A bit of pain felt among the uranium miners, Deep Yellow among those. Drone Shield coming off. Catalyst Metals also on the downside as far as the gold is concerned. In the small cap land, we've got Stack Latrobe Magnesium, which has been on a tear since that deal out of the White House. Core among those lithium stocks that are moving higher as well. On the negative side, what we've seen in the smalls, Astron of 15%, Austrad Materials also lower, along with Freelancer. Let's take a look at what is on tonight, and we do get PMIs out of the EU and US, and critically that inflation read for September out of the US due, also bearing in mind the US government shutdown. So it's anticipated we will get some data there, and the US Consumer Sentiment Index also. And next week, looking ahead, we'll get some more commentary from RBA Governor Michelle Bullock, and critically for us, Wednesday, inflation data for September, which may well determine if we do get an interest rate cut. The following week on Melbourne Cup Day, we do have the Fed rate decision the same day. Wednesday, big central bank moves next week with the BOJ and also the ECB making decisions, and then we get price indices later in the week, as well as that core deflator as well in the States. So let's recap where we have finished for today. On the SIBO 200, down around 0.1%, and on the ASX down a little more. In fact, that's just changed. It's now down a similar amount at this point, and for the week we are up around 0.25%. That is the COB. Thanks for watching and listening. We'll do it all again on Monday.
The COB is brought to you by Montgomery Investment Management. The world is volatile. Your financial future doesn't have to be. Find out more at montinvest.com.